Okay, traders, welcome back to the Price Action Labs YouTube video. Here we're going to be going over the final series of the order flow videos, right? So in this video, we're going to be going over something very special. We're going to be starting with the higher time frames, as some people have requested, and then we're going to go down to the lower time frames. So on the higher time frames here on the Nasdaq, we're going to be going over, sorry, not Nasdaq, actually, let's do ES. I prefer ES over Nasdaq, right? So here on ES, we're going to be going over very, very basic kind of market structure. We're going to be going over how you can go from higher time frame down to lower time frame, right? So the first thing you want to understand is your market structure, right? So our market structure is as follows. We had a structural high, we had a structural low, right? So I'm just going to be marking out the structure the way I see it, right? So with market structure, you want to be about 80% correct, right? Compared to this, you can have a slightly different market structure to me, but you will find that we will often end up at the same results, right? So we have our market structure highs and lows. We have a break over here. And now from here, we've had a break over here. Now, this is interesting to understand. This is very, very interesting. Well, we're going to be going over a trade on Monday, the 27th of January, time of recording, right? So why did we have such a sell-off over here? So it's important to understand this, right? Let's look at market structure again very, very closely. So we had a structural high and we had a structural low down here. Now, this here was the structural break, right? This here was a structural break, and we're above this area. When we're above and high, we can expect a pullback, right? This is very, very basic kind of market structure, right? So when it comes to market structure, you want to understand how we are actually looking at it from a basic level, because we have a high pullback, high pullback, high pullback, and now we've had a high, right? So now from here, we are simply looking for a pullback because we're above this all time high or above this high. So whenever you have a high, you are looking for some kind of a pullback, and that's exactly what was going on over here, right? So whenever you take trades, you want to understand where you are in terms of basic market structure. Very important to understand this. Now from here, we have a dealing range, right? So a dealing range is simply the most recent structural high and the most recent structural low, right? So we're looking at these two areas. This is step two. So step one is market structure. Step two is the dealing range. The dealing range is simply the most recent swing low to the most recent swing high. Right now, from here, we're looking at an area, right? The most important number here is this 50% level, right? And we all know why. Anything below is a discount, right? So we're looking at a discounted fair value gap. So we are looking basically at this area over here. This is my point of interest. This is my POI. Again, quickly, what makes a POI? Three simple steps that make any POI. The first thing we're looking for is a shift of the market structure. The second thing we're looking for is for price to be in a discount. And the third thing we're looking for is for price to leave a fair value gap. So we're looking at these three things every single time you are looking for a higher time frame fair value gap. So with that being said, we will now go on the lower time frames and understand what's going on, right? So this is essentially our point of interest. Let's just bring that up one more time, right? This is a point of interest over here. So now from here, we're going to be going and dissecting a trade in a lot of detail, right? We're going to be understanding why the markets were essentially bearish, right? The reason the market was bearish is because of two reasons, right? First of all, we're in the 50% level, but we're above the 50%. So we're in a premium, and we also have a fair value gap down here. So the market will move from premium to discount and discount back up to premium. And we're using fair value gaps as a magnet on the lower time frames for entry. With that being said, now let's go down to the next time frame I use, right? So the next time frame I use is the 15-minute time frame, right? So the 15-minute time frame, of course, we had a very, very large sell-off, right? And the reason we had that sell-off is simply because the market was giving a higher time frame retracement, a 4-hour retracement. So now let's look at this kind of session over here, and let's break down a trade you could have taken, a quick scalp, right? Nothing crazy. The first thing to understand, right? Let's quickly go to our indicators, right? So which indicator do I use? So I use the Asian session range by Rob Minty. Again, quickly go over settings, right? So start time 8 o'clock to midnight. Very important. You have your midnight style. You only want to look at the London and Asian session. You don't want to look at any other sessions. No labels, no lines, right? This is the basic setting for the Asian range. If we just get this up again, the Asian range color is going to be an orange. We'll get that up. So this is, of course, the Asian range here in orange, right? That's the first thing. The second thing we look for, very, very important indicator, is we look for the PO3. So the PO3, we look for it by 2 degrees, right? 2 degrees PO3, just like this. So the PO3 again will look something like this, and we're simply using the daily PO3, right? Daily PO3 using the New York midnight opening price. Now from here, we understand how the Asian session has behaved. The Asian session was a large sell-off, and now we have a fair value gap over here, right? This is an inefficiency or an imbalance. So these are the 3 steps I use to any particular strategy, right? So the first step I look for is, of course, a 15-minute fair value gap, right? So a 15-minute fair value gap is something we see over here. Price has left a 15-minute fair value gap. When we zoom into this, what we're really looking for is we're looking for the last candle before the imbalance. So you can see the imbalance was just over here. We on the 50-minute time frame are using the last candle before the push lower. This is important to understand. This is kind of step one of the strategy. So now that we have that, let's quickly go back and put that in again. So this is the 15-minute fair value gap, right? So from here, we now head down to a lower time frame, such as a 5-minute or a 1-minute. I'm going to go down to the 1-minute, right? We're going to understand how you could have taken this particular trade, right? So the first thing, again, we need to understand, step two of the strategy is we're waiting for the market to enter on the 1-minute time frame, the 15-minute fair value gap. So we can see prices headed in. And this is where I'm now going to switch the power of 3 to the 4-hour power of 3, right? So the 4-hour power of 3, again, this is now the 2 p.m. Eastern Open. So the 2 p.m. Eastern Open is 7 p.m. UK time. So you're looking for the open to be round about this area. So this is the open. So you can see we're well above the opening, which is good. And we're at a 15-minute fair value gap. This is most of the work, right? This is most of the work, right? So you're looking for a location to trade. We're above the 4-hour candle opening. In this case, it's a 2 p.m. Eastern. And we're inside of a 15-minute fair value gap. This is what gives us our indication to look for sells, right? But before we go and look for sells, we need to understand what's going on in this region, right? So we are looking very, very specifically at how price enters the zone, and we're looking at this wick over here, and then we're also looking at how price behaves out of the wick. So we're looking for these particular areas, right? So again, if we just can quickly bring this up, right? Let's bring up the footprint charts, because the footprint charts give you an indication as to what's going on. So without the footprint charts, it's very, very difficult to trade. We can see price has aggressively entered this area, right? What do you see with the delta, right? So if you've not watched some of my previous videos, I highly recommend checking them out, because those videos essentially give you what's going on between the buyers and sellers and how you read footprint charts. But here we have a lot of aggressive buyers. We have so many aggressive buyers here, and we have so many aggressive buyers here. In fact, I'm going to draw your attention to this candle. We have 298 for 573. That is a lot more, almost double the amount of aggressive buyers than the aggressive sellers. That is very important to understand, right? The second thing to understand is that we also have the same exact thing over here. We have 625 for 108. So we're seeing so many more aggressive buyers than sellers, right? Now let's go back to the regular candlestick chart. Let's understand what's going on over here, right? So we see a ton of aggressive buyers in this area. There's so many aggressive buyers I've labeled here in yellow. Now from here, we see those aggressive buyers, but were they rewarded? Were those aggressive buyers rewarded, right? So buyers came in, tried to drive price higher, but they failed, right? Because if they succeeded, they would have broken the zone, right? But they failed. This is the reason why we're now looking for sells, right? So the first reason, of course, we're above the candle opening. The second reason is that we're in a fair value gap. The third reason is that we've had order flow confirming that buyers have failed. So when buyers have failed, you are now looking for shorts, because we understand aggressive buyers have failed, right? Quickly going back to the footprint chart and the order flow, we can now see aggressive buyers have failed at this level. So this is an accurate level to trade from. This is a successful level you want to be trading from. So from here now, we can simply take a trade, right? We can take a trade from here with a stop loss comfortably above this wick. Again, above this wick, we saw buyers fail. So when buyers fail, we understand that aggressive sellers are really in control. The sellers are in control. So again, we can simply target the candle opening, right? A nice 1 to 3 R trade from this particular area, right? So again, catching trades like this all comes down to using a few basic principles. Let's quickly go over them, right? So the first thing we're looking for, again, is a level, a key level. 15-minute fair value gap. This is the most important thing. 15-minute fair value gap has to be there, right? No level, no trade. It's as simple as that, right? No level, no trade. No level, no trade, right? Very important. No level, no trade. Very, very important to understand that. Now, when we head down, we're going to get this 15-minute fair value gap back up again, right? When we have this 15-minute fair value gap, we were simply using lower time frame order flow to enter the trade, right? So let's look at this 15-minute fair value gap. Now we head down to the 1-minute time frame. So on the 1-minute time frame, this trade could have been taken successfully round about this area, and we're simply looking to target the opening candle over here, the opening of the candle, right? So we're above the candle, we're inside of a 15-minute fair value gap, and the 1 minute has failed over here. This is the reason why price moved downward, because buyers failed, sellers were aggressive, and they won, and we're at a key level, so we've ticked the location box. Then we simply target the candle opening over here, right? This is how simple the strategy is, and this is how simple your trading actually should be, right? Get a level, wait for price to get to the level, and then read the order flow. It's as simple as that. So the only thing that's getting in the way is you, right? So a quick tip as well, you don't want to be using the power of three indicator blindly. You need to be using order flow and fair value gaps to validate every single one of your trades, right? So that's it. That's the entire order flow series. And the next few videos are going to be on specific questions that people have. We're going to be going over liquidity, fair value gaps, and more in depth on the order flow, on the order flow, because I really want traders to understand this in 2025, right? So if you had any questions on that, feel free to leave it in the comments, and I'll look forward to seeing all of you in the next one.